All right, stocks really kind of fell out of the bed today, and now like all these signs that we've been seeing with the Dow Jones in terms of starting an intermediate decline, the Russell 2000s kind of followed suit. Now we're finally seeing that on the S&P 500 and the Nasdaq. We've been in this convergence mode for a while. We've been seeing these signs of the beginning stages of this decline because they're so bullish. It wasn't going to start in one day. It's been a lot. It's been gradual. But now we're starting to see definitely the signs that we're in an intermediate decline. The question, of course, is how long, how far. We'll take a look at some of these things. We'll take a look at what's driving a lot of this price action. That will also dictate how long we're in this risk aversion mode, and whether or not we can bounce back up and start a new long-term trend to the upside, long bullish move to the upside again. It's kind of expected that we'll do that since that's been the precedent over the last couple of years. So we'll talk about that based off of the intermarket relationships that are driving this action and the sector rotation that's clearly shifted towards the areas of the market that outperform when the market is not performing very well. So we'll break all that down, take a look at our trade ideas stock that really broke down hard, similar to what we saw last Friday, stock that kind of broke down below its 50-day moving average, filling into that gap between the 200, the 50 and the 200. So we'll talk about how to trade that as well. So let's go ahead and get started. Today is Monday, April the 15th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. That's where I check out all the old trades, see if there's anything we need to close out. We actually did close out a trade today, just because it kind of it's running out of time with April expiration coming up. So check out those reviews there. I also put on today's trade idea already before the market closed that you'll hear later in the video. Click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab, hit that like button. Again, the more you do that, the more it helps get our content out to all of our followers on these two different platforms. It's a big deal to us. That's why we always ask. So thank you to those who like these day in and day out. Our goal is to get to 100. So if you're not liking these and you're watching these videos, you want to let me know I should keep doing them, just click on that. You can do this with one or two really easy clicks while you're watching. All right, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator. As you can see, the intermediate line has now broken below the 50th percentile, which is why we're now dark pink shading. The moving average has turned lower. We're below it, which is now why it's a red line. That constitutes an intermediate decline, right? At least the beginning of one when you have dark pink shading and red line. That might be all there is to it. I don't think so, but that combination is what starts an intermediate decline here. Obviously, the short-term sentiment's bearish. That's not surprising to get it down. The near-term line is in the reversal zone. That's, after a bearish peak, that's a pretty bearish low point. The momentum line did not get to extreme low, but that's not as important as the near-term line because that's the one that's kind of has more staying power. We are 2% below the moving average, right? It took like about right here for us to get to exactly the same 2.18%, right on this day there. So on this day right up here, we got 1.8% below, and you can see that's far enough to start a new intermediate decline. 2.5% is that dotted line right there. The market sentiment's falling. It's still in the reversal zone, so that can be a while. Last time the market sentiment line did get all the way down almost to the lower reversal zone during that intermediate decline that went all the way to the 200-day moving average. I don't think this one will go all the way to the 200-day moving average, but it's probably got, and I won't go that much further, I don't believe, but it's got some little bit of room to grow here right now. And you can see your Dow Jones Industrial Average got a cluster today, right as the intermediate line got in the reversal zone. So again, similar to what we saw back here. Again, that can signal the end of this move, just like that, or it can, it could be the beginning. That we've at least now gotten below the 23% retracement level. If I were to look back at the S&P 500, S&P 500 here and pull up the Fibonacci retracement lines, you can see we still have not broken the 23% retracement of the prior intermediate rally that we've been on. So we're kind of goes to show just how more bearish the Dow Jones has been. Now, obviously, we're 3% below, which that doesn't itself give you the red dot down here, but we are in the lowest decile of how far below the moving average we are for the past year. If I were to zoom out a little bit and go out 3 years, we can see the correction of 2022. You can see we're in the 30th percentile. So there's when we are in a bearish decline, you can get a lot more bearish than 3%. But 3% is about as deep as it's gotten here lately, as obviously in the past year. If I take a look at the Russell 2000, it also came really, really close to producing a cluster here. You can see the intermediate lines at 21.5. That's how close you were to getting a cluster on the Russell. We obviously have broken below that 23% retracement level. We have dark pink shading in a red line. The market sentiment line's falling, and it's actually a lot lower than where the Dow Jones is. So things are clearly turned over. There's your NASDAQ. Your NASDAQ is, again, just like the S&P, the first day of dark pink shading a red line, we closed below all these lows. The last 2 bull tags we got, and now we're below both those lows. We never did get above that high point. We failed there a couple days ago, and now we're below both those lows. So, we are now in intermediate decline. No more bounce like this bull tag. We are now in an intermediate decline there. Down 2%, the intermediate line almost in bearish territory, short-term sentiment. This near-term line didn't drop as low during any of these declines like it did on the S&P. So this is actually the first time the near-term line's been this far in the oversold reversal zone since the very beginning of the year, where we had this decline down to that bull tag, and then we bounced back up. So obviously things are clearly moving lower. You can see the weekly chart now for the S&P is bearish. We have the red arrow now. The PPO is falling, still at the 86th percentile, so it's actually still pretty bullish. Of course, your Dow Jones Industrial Average, we have now a second straight week of bearishness. We're still below that average down there, and now that PPO is falling, getting closer down to that the 40-week exponential moving average. If I look at the 3 green arrows, obviously we have three red arrows around the board. The Dow and the Russell has had it quite a bit. The NASDAQ you can see now, and the S&P, and they all have red lines. So we have we are in intermediate decline there. Everything is 3 red arrows and the pink shading here. You look at the 2-line version of this chart, we have broken below the 50-day moving average for the first time in a long time. Again, you generally fill in the gap between the 50 and the 200 once you start to break down. I think you'll start to get, I think our worst case scenario, which is likely we don't even hit this, but our worst case scenario is going to be down to this 480 level. That's the old peaks that we had prior. The 38% Fibonacci of this move lines up on top of it. So very, very strong convergence there of support from different Fibonacci retracement levels. You're clearly bearish in the MACD now. Stochastics in bearish territory. Looking at some of these other oscillators, looking at the DMI, we are almost above 30 on the negative indicator, but clearly below 20 now in the positive. So things have definitely changed in that regard. The diamonds are above 30 and below 20. Your ADX is rising up above 20 there. So things are bearish in that perspective. IWM is looking the same, above 30, below 20. Your ADX is rising. Your RSI and the CCI finally now broken down below 40, right? So we had some, we can actually go back over here to April the 4th. So April the 3rd actually would be our last day of this, April the 3rd right there, because now we have pink shading here. So we can draw this pink shading from here, starting when we broke on 4/4. So this would be, let me just make sure I got that right. There we go. So now we got the pink shading started. This though, our weekly has to cross below -100 before we can stop with the green shading there. So that's obviously not the case. So we can keep that green going. But you can see now we have definitely turned on the daily chart for RSI. We have definitely turned bearish now that we've crossed below the 40 level. Of course, that's been the case for these other indexes. The Dow Jones is clearly below 40. The Russell 2000 clearly below 40. So things have definitely changed. But your SPX is the one that's just kind of barely joining the party here. If I were to look at the Ichimoku cloud, we are now looking at filling in, getting inside the cloud here. We have lost that bullish trend that we had. So things that we have a negative rate of change for the first day there. And we are below the cloud on the Dow Jones, and we have almost an intermediate trend strength. Has to get to -2 and then above 65. So we have half of it, but we don't have the other half, but we're close. So we're almost at intermediate trend strength already there on that on this new intermediate decline to the downside. We have dropped below the lower Bollinger Band, and we're that close to being below the lower Keltner channel as well. So big breakdown. The first time we've had negative momentum in months here. The bands themselves are still inside the Keltner channels. The bandwidth is rising. It's still at very, very low levels. So things are kind of just starting. Your Dow Jones bandwidth has been rising for a while now. The bands are outside the Keltner channels, and you got some pretty strong momentum as we continue to trade. We finished Friday below the Keltner channel, and we easily cleared below that there today. Looking at the 4-week range, we got a new 4-week low point for the first time today, right? So that's the first time we got a new 4-week low point. We're below the value area. Clearly below the point of control, below last week's low point. We did get a lower high, slightly lower high after the gap up. Filled in the gap immediately, got a clear lower low point. Your Dow Jones, you can also see too that the size of the channel had been so extremely low, it's starting to move up. If you look at the diamonds, we got a new 4-week low point there as well, but we've already had that for a few days now, and that band, the channel is really getting bigger pretty quickly on the Dow Jones. So you can see the Dow is kind of setting the pace, and the S&P is starting to follow along with the bearishness that we're seeing. Today's volume and trading range were pretty large, 11.72 on the volume. It's it's a big, or excuse me, on the range, big range to the upside, way off the charts when you're looking at the 52-week range for the ATR. If you look at the volume here really quick, at 92 million, so we're above the average, but we're not 1.5 times, right? We've only had 1.5 times a couple of days here, and we had one over here, but we haven't had one yet below the moving average, right? All those other black arrows came with the index up above the moving average. So you can see again the volume at 92 million was still that's enough to bring the average up. The ATR, of course, almost at 52-week highs. The ATR itself now on a relative basis, that's not the case. But you are clearly above 1% now, which, again, another sign that we're in intermediate decline there. If you take a look at the VIX today, it jumped up. It did not jump above 100%, but it did jump up above 95, so we are clearly above 95 there. The VVIX is up to 109. It's the highest level it's been since last October when we were washing out. So volatility is clearly moving to the upside. We talked about that we were due for VIX to expand, right, to make it an expansionary move to the upside. Well, here we go, right? Now we're making that expansionary move up to the upside as we finish this April expiration. I kind of thought it would be, potentially the May expiration cycle that does it, and it looks like we're going to finish up this April expiration cycle with a pretty decent move. And again, still not big enough that it's big enough that we can follow through with this, because we're still actually below the 200-week moving average, and everything is just turning up. So we might get another one in May, despite the fact that we are getting this move here. We're clearly above the 200-day moving average, and all these averages are starting to rise. So clearly a big time move in volatility. It's suggesting again that that we're not washed out, but we're definitely starting a new leg lower. Finally starting to retrace some of this tremendous move we had over the past 5 months, and definitely not retraced it enough to where it was like we're so extremely oversold, not in the least bit. But it also doesn't mean we have to retrace it very much. It's a very strong bullish move, You know, there's a good chance that we might just kind of maybe hit up to 20 on the VIX and not really go further past that, at least on this, maybe on this first leg here before we get a bounce. And then I think we get more of a bearish leg after we get a little bit of a bounce here first to the upside. All right, now let's take a look at what's driving this price action. As you can see, gold's been the big winner over the past 3 months, and after up and down a couple of days, it's really taken off here today. So let's just zoom in on just today alone. So bear with me 1 second while I bring up today's chart here. And we'll go to April the 15th. And just look at today, and you can see big move higher on gold. A lot of geopolitical risk right now in the markets. Big move higher on yields. Yields really started the day with the biggest, and bonds had the biggest drop. They kind of just languished all day, kind of at the same levels. Qs actually started off the day bullish before finishing the day with one of the biggest losses on the day among these different asset classes. IWM also joining the party down there, so it's pretty broad move selling to the downside. You'll see that here in just a second. Emerging markets outperforming U.S. equities, developed markets as well. You can see commodities were bullish, the dollar was bullish, and yields were bullish. That's your three-headed monster, right? Not such a big move on commodities in the dollar, but commodities did come off their lows, and the dollar stayed positive the entire time that yields were so strong. And like I said, of course, gold continues. Remember, gold is on a parabolic, one of its biggest parabolic moves it's seen. And when it typically does this, you know, it typically kind of pulls back pretty sharply. That you would expect that if the dollar is going to start to make its own run. You can see the dollar here is also starting to make its run. Look at the positive DMI at its getting above 40. It's been a long time since the dollar had a DMI get above 40. You have to go back way over to here in May of 2022. At the very end of 2021, these are kind of like the beginning stages of this correction that ultimately turned into that correction there. We're starting to see that again. So big move on the dollar. I think ultimately that's going to have an impact on gold. So I don't think gold is going to be able to maintain this parabolic run that it's been on. Crude oil, of course, has also been on a pretty strong trend to the upside and still maintains that trend. It's commodity prices are clearly above the 200-day moving average. The crude oil prices are kind of stabilizing there at about 85. You see the dollar clearly above its 200-day moving average, a big trend moving to the upside. You saw that in gold as well. Look at that parabolic move. That PPO. Remember, this is apples to apples, so it's not just high because the price is high. You can compare it across long time frames. You can see again, this is one of the strongest runs on gold really since coming off of COVID. And like I said, that kind of we're unable to really sustain that. It was such strong momentum to the upside, and now we're kind of getting a little bit of divergence there on the. You're getting a little bit of divergence on. That the stochastic, as well as you can see here on the CCI as well. Look at the RSI, as strong as it is. You can see the weekly RSI is up to almost 80. Again, that's the last time we saw that was there in 2020. And again, we ultimately went to a bearish result there, getting below 40 on that decline after that parabolic peak. So definitely moving in that direction here. Here's gold. Well outside of its Keltner channel, still trending up to the upside. Crude oil has been outside the Keltner channel, still in the upper half of its chart. The dollar has been outside of its Keltner channel as well, so we're in trending mode on the dollar too, outside the Bollinger Band for that matter too over the past few days. So some strong moves that suggest that this weakness that we're seeing in equities might not be so short term, because again, these are three different things that equities have shown in the past couple of years they don't do so well with. Equities don't do so well with rising yields. They don't do so well with strong dollar. They don't do so well with rising commodity prices. As you can see here, the 10-year yield up to 4.62%. Again, that's kind of where we were getting there in October when things kind of hit the fan last year during the one intermediate decline that we had there late late summer, early fall. So significant move. Of course, that's a function of rate cut odds dropping. You can see the rate cut odds are about 12%, 11.5% for no rate cuts by the end of the year. It's up to 43% for only one. So that, just about a month ago, we had a 90% chance that we get more than one cut. Now we're not getting it. We're like down to the 50s. So the rate cut odds for July, or for June, excuse me, are down to what, 20% is all. We were at high levels for a rate cut previously here. Just early February, we were sitting at 90 some odd percent odds of a rate cut at the June meeting, and now we're clearly not. So the sentiment's definitely changing in terms of when the Fed will actually cut rates or not, and the market kind of had these high valuations baked in because of this expected that we'd bring rates down, even though falling rates hasn't necessarily been a bullish sign. That's been the kind of the bullish narrative here, that we want lower rates. The breadth has clearly dropped to the downside in the big washout move way below zero. Like the moving average yet hasn't moved below zero yet. So clear bearish move here, well below the average. You can see the number of stocks above the 50-day moving average has broken the 200 level. So that's bearish territory. Typically, you're bearish territory. You're bearish once you break below 300, but now you're below 200. You are in bearish levels. That's the 40% mark for the number of stocks. Your number of stocks above the 200 is still kind of holding up pretty strong at 351. It's below the average, right? But it's still at least in the upper half, right? We don't get to correction mode until you are below 250. This one takes a lot longer to fall, but the fact that it's actually below there now, this has jumped up to 1.72 already. So the ratio of the number of stocks above their 200 versus the number of stocks above the 50 has really jumped up. So we're definitely getting kind of a little bit of a washout moment here. We're not below minus 1,000 on the McClellan oscillator. That would be something to kind of keep an eye on. Oh, we did finally. We were at 79 when I was looking at it earlier. We actually did get below minus 100. So that is a pretty decent washout move for this. You can see we washed out there at below minus 100. We washed out over here below minus 100. That tends to kind of coincide with the washout, even though on these others, like for example this one, we were barely crossing below zero when we got it. This one we were crossing below minus 500 when we got it. We're barely crossing below positive 500 with this one. So as much of a washout move there is, there hasn't been much of a move to wash out because we've just remember, we haven't even broken the 23% retracement level. So it kind of goes back to just these really small moves that look a lot more bearish, and that's just kind of the nature of the market cycle. Obviously, you are in bearish levels here, your extreme lows now. So clear bearish move in terms of where we are inside of that range. Looking at the money flow, you can see the money flow is in bearish levels, almost below 40, but definitely in the lower half of the chart. So the money flow, like the volume has been dropping, the breadth has definitely been bearish. Things are definitely changing. We talked about how we haven't had a 2% decline. We made this record move without a 2% decline, going up 27.5%, more than 27.5%. Well, now we've had a 3.5% decline. And more than likely, that number is going to be right around that 5 to 6, 7%, maybe up to 8% range. Most likely not going to get to the double-digit range, which coincides with something more. Obviously, we'd have to get to the 200-day moving average. We have to kind of get that double-digit type move, and I don't think that that's going to be the case. I think we're going to stop short in that 5 to 7% range and produce a new red tag, because on this chart now we have the red tag set for 5%. So I do think we'll get a new red tag before it's all said and done, but it won't be. We won't be, just dropping sharply, especially now that we got below the minus 100 level. This might be the bulk of the bearishness in terms of the momentum of the bearishness on this current run. Again, if I go back to the MACD, the histogram, it is pretty low. If I were to go back 3 years so I can see the correction, it's not that low compared to what we saw if you follow my cursor on the histogram over to the right. Even the MACD itself got a lot lower on some of these intermediate declines, and we're just barely dropping. So there's more to come on the downside. I just don't think we're going to be I definitely don't think we're hitting the 200-day, and I really don't even think we're going to be hitting 480. I think we'll kind of stop somewhere here around this 23% retracement level, enough to get that 5% mark, enough to get the MACD to bottom out, similar to some of these other intermediate levels, before we bounce back up. Now, when we bounce back up, if we do get up to new highs, it won't be very much of a new high, and then I do think we will get more of a move down to the 200-day and potentially beyond afterwards. I just don't see that being the case on this current decline. Let's take a look at how the sectors performed today. So let's pull up the sector comparison chart. You can see energy has been kind of outperforming as we've gotten more bearish. Energy tends to do well when the markets, especially the cyclical areas of the market, aren't doing so well. But today it was kind of a risk-off day. Healthcare, staples are your best performers. Utilities was there, outperforming slightly. Real estate, member, has been behaving very similar to some of these XLK, XLY names, XLC. So not surprised to see it kind of not performing like a safety trade and more like a cyclical trade, and that's the kind of nature it has right now. Again, very similar to those three, and those three, they're the biggest losers, and they will, when the markets start to roll over, they will be the ones that roll over the most. So we started off pretty strong here. IWM had the biggest loss. The Qs ended up losing more. We're still above all these moving averages, but if we were to break this 200-day, then it's going to be a lot more. Then I'm going to actually be wrong, and we're going to be a lot more bearish than that. So I don't see that happening on this go around, but I do see once we do break the 200-day, that will be more of a bearish sign than what we're going to be comfortable with. And whether that happens in Q3, which is most likely during that seasonally bearish time of year. Remember this. The market has multiple seasonal times of the year where there's some volatility. The first quarter is one of them. The first quarter generally is one of them. The second quarter is another one. And we're starting to see that here. And then the third quarter is another one. So this is the one where I think we're going to be a lot more bearish. I don't think we'll see that necessarily here. But since we didn't get this first one, we might have pulled a lot of this forward to where we actually might get more of that steeper decline. And then you can see that being a possibility. I just don't see that likelihood up there to the higher probability levels. All right, that brings us to our trade idea of the day. I'm going to take a look at Salesforce. Salesforce is kind of like JP Morgan on Friday. Really kind of broke down today. Obviously not on its earnings announcement. I think it's buying somebody out, but it broke down pretty hard. Almost got its own cluster. Came pretty darn close to its own cluster. Almost 10% below the moving average, which is its lowest point below the moving average of the past year. If I were to go back 5 years, so this would include COVID, we were a lot further below. Even if I were to take away the COVID year, we're still only in the 16th percentile. So you can see, especially when you got that, after a big bullish trend like we just saw once we started the bearish decline, it started with a pretty steep drop, similar to what we're seeing, with a cluster, no less, and being pretty decently below the moving average. So similar to the type of situation I'm seeing right now. If you take a look at the weekly chart for CRM, you can see we are turning bearish here. The PPO has been bullish for a lot longer than it was in 2021. Pretty decent sized candle to the downside, the type of candle that starts bearish moves when you haven't been bearish, at least. When you look at the two-line version of the MACD and stochastics, look at that. You're kind of breaking into the gap between the 50 and the 200-day moving averages. When you look at the DMI, you can see a big break up above 40, well below 20 on the positive indicator as the ADX is rising. When you look at the RSI and the CCI, you can see well below 200, breaking below 30 on the RSI, so big time drops down there. Looking at the Ichimoku cloud, we are well below the cloud now, breaking below the cloud. The rate of change is significantly bearish. We have a weak bearish trend trying to get to intermediate trend strength. And then of course you're below both the, not surprising that you're below both the lower Bollinger Band and clearly below the lower Bollinger Band, as well as the lower Keltner channel. And your bands themselves have now moved outside of the Keltner channel. So what I decided to do on this trade was to come over here and sell the 260, which was a low 20 delta when we were looking at it, buy the 270. So that's the trade setup that we had. You can see the stock is already down from the time we got into it. We got into it here when we got into the trade eventually. The stock was right around 273. Or excuse me, when we got into the trade, stock was at 280. It's at 273 again when we put it on before the market closed. Now it's at 273. So it's had a pretty decent move to the downside already. But there's how much flexibility I have to work with in terms of the timing of the trade. And then I have a very, very low risk for the reward potential that we could get if it does break down below 260 here. Alright, that is it for today. You've heard from me. Now I want to hear from you. Use that link popping down at the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com for free. Follow me and like me on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.